Preparing for a CMS Energy FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join CMS Energy in an FP&A role. I am drawn to FP&A because it combines analytical discipline with decisions that affect operating performance. My experience includes budgeting, variance analysis, financial modeling, and presenting insights to non-finance partners. CMS Energy is especially appealing because its utility platform has long-term, capital-intensive planning needs while its clean energy transition creates meaningful investment questions. I would bring strong attention to detail, curiosity about operations, and the ability to translate financial results into practical actions for business leaders. While answering, connect your financial analysis, forecasting, and communication experience to CMS Energy's regulated utility operations, clean energy strategy, reliability priorities, and customer-focused business model. Question 2. What do you know about CMS Energy and its business model? CMS Energy is a Michigan-based energy company whose principal utility business, Consumers Energy, provides regulated electric and natural gas service. Its economics depend on customer demand, approved rates, operating costs, weather, and substantial infrastructure investment. That makes FP&A important for balancing reliability, affordability, regulatory commitments, and returns on capital. I also understand CMS Energy is pursuing cleaner generation and emissions reduction, so planning must evaluate both near-term financial performance and long-term transition investments. Make sure to cover CMS Energy's utility focus, Consumers Energy's regulated electric and natural gas operations, rate-regulated economics, infrastructure investment, and the importance of affordability, reliability, and decarbonization. Question 3. Walk me through how you would build an annual operating budget for a utility business. I would begin with a calendar, prior year actuals, strategic priorities, and agreed economic assumptions. Then I would work with operating teams to forecast customers, usage, labor, fuel, purchased power, maintenance, and other expenses. I would separately integrate the capital plan, depreciation, financing effects, and regulatory assumptions. After consolidating submissions, I would challenge major movements, run sensitivities, reconcile to the income statement and cash flow, and present a clear budget story for leadership approval. In your answer, talk about establishing assumptions, collecting department inputs, forecasting customers and usage, modeling revenue and expenses, incorporating capital plans, challenging submissions, and obtaining leadership approval. Question 4. How would you analyze a monthly actual versus budget variance? I would first identify material variances by account, business unit, and timing, then separate one-time or timing items from recurring performance. For a utility, I would investigate weather, customer usage, fuel prices, purchased power, outages, labor, maintenance, and regulatory activity. I would validate explanations with the responsible business owner, quantify forecast implications, and update the outlook when needed. My final communication would explain the driver, whether it is controllable, and the action required. Be sure to mention materiality, timing versus permanent drivers, price-volume mix analysis, operational context, root cause validation, forecast implications, and concise communication of recommended actions. Question 5. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial target for a defined period and provides accountability for spending and performance. A forecast is management's current best estimate of what will actually happen, incorporating updated results and assumptions. A long-range plan extends several years and links strategy, capital investment, regulatory expectations, financing, and earnings goals. In practice, I would use the budget to measure performance, the forecast to guide decisions, and the long-range plan to test strategic sustainability. While answering, distinguish the budget as an approved near-term target, the forecast as the latest expected outcome, and the long-range plan as a strategic multi-year view with different levels of precision. Question 6. How would weather affect CMS Energy's financial forecast? Weather affects both demand and costs. Colder winters can increase natural gas usage, while hotter summers can raise electricity demand, but the revenue impact depends on rates, customer mix, and regulatory mechanisms. I would compare actual heating and cooling degree days with normal conditions, estimate the financial effect, and distinguish weather from structural usage trends. I would then update the forecast using normalized assumptions and present upside, downside, and base case scenarios. Make sure to cover heating and cooling degree days, electric and gas demand, revenue sensitivity, purchased power and fuel costs, normalization methods, scenario analysis, and distinguishing weather from underlying customer trends. Question 7. How do regulated utility rates influence FP&A? Regulated rates influence how a utility recovers prudently incurred costs and earns a return on approved investment. FP&A must understand rate case timing, authorized revenue, fuel and purchased power treatment, capital additions, operating costs, and regulatory assets or liabilities. I would distinguish approved outcomes from management expectations, model timing carefully, and monitor whether actual results are tracking the rate plan. That discipline helps avoid overstating earnings and improves communication with operations and leadership. In your answer, discuss rate cases, approved revenue requirements, allowed returns, cost recovery, regulatory timing, deferred balances, and the need to align forecasts with authorized versus anticipated outcomes. Question 8. Describe your approach to forecasting revenue for an electric and natural gas utility. I would build revenue from operational drivers rather than simply applying a growth rate. The model would include customer counts, usage per customer, residential and commercial mix, weather assumptions, approved rate changes, riders, and billing timing for electric and gas. I would reconcile projected volumes with operational data and compare the result against historical seasonality. Finally, I would test sensitivities for weather, customer growth, and consumption trends before incorporating the forecast into earnings and cash flow. Be sure to mention customer counts, usage per customer, weather normalization, rate changes, customer classes, riders, billing timing, and reconciliation to operational volume and regulatory assumptions. Question 9. Which KPIs would you monitor in a utility FP&A role? I would monitor revenue, operating expense, adjusted earnings, cash flow, capital spending, and rate base growth alongside operational indicators. Important measures include customer growth, electric and gas volumes, outage frequency and duration, reliability performance, fuel and purchased power costs, safety, and emissions progress. I would also track forecast accuracy and budget adherence. The key is connecting each KPI to a financial driver, so leaders can see whether operational performance supports the expected earnings and investment outcome. While answering, identify financial, operational, customer, reliability, capital, and environmental metrics, then explain how each KPI supports forecasting, performance management, or strategic decision-making. Question 10. How would you evaluate a proposed capital project at CMS Energy? I would first clarify whether the project is required for reliability, compliance, customer growth, or strategic transition. Then I would model construction spending, useful life, operating costs, savings, tax effects, financing, depreciation, and potential rate recovery. I would evaluate NPV, IRR, payback, and cash flow timing under multiple scenarios, including delays and cost overruns. A sound recommendation would balance quantitative returns with reliability, regulatory obligations, customer affordability, and long-term strategic value. In your answer, cover strategic rationale, reliability and regulatory requirements, capital cost, operating savings, rate recovery, NPV, IRR, payback, risk, scenario analysis, and cash flow impact. Question 11. What is the difference between capital expenditures and operating expenses, and why does it matter? Capital expenditures create or improve an asset that provides benefits over multiple periods, while operating expenses support current operations and are generally expensed as incurred. The distinction matters because capital spending affects cash immediately but flows through earnings over time via depreciation, whereas operating expense affects current earnings directly. In utility FP&A, classification also influences rate base, regulatory recovery, project approvals, and performance accountability, so I would validate treatment with accounting and project owners. Make sure to explain capitalization criteria, recurring operating costs, depreciation, earnings timing, cash flow classification, budget ownership, and why accurate classification matters for regulated utility planning. Question 12. How would you forecast cash flow for an energy company? I would start with forecast earnings and convert them to operating cash flow by adjusting for depreciation, non-cash items, working capital movements, and regulatory balances. Next, I would incorporate capital expenditures, asset sales, debt issuance or repayment, dividends, taxes, and other financing activity. I would reconcile beginning and ending cash, compare the result with liquidity requirements and debt commitments, and run downside cases for higher capital costs, weaker demand, or delayed regulatory recovery. Be sure to mention operating earnings, working capital, capital expenditures, debt activity, dividends, tax payments, regulatory balances, liquidity needs, and reconciliation between the income statement and cash flow statement. Question 13. Tell me about a time you improved a financial reporting or forecasting process. In a prior role, a monthly reporting process relied on manually combining several department files, which created delays and inconsistent definitions. I standardized the input template, added validation checks, and built a consolidated model with documented formulas and ownership. The process shortened reporting time by approximately 30% and reduced follow-up questions because managers could see their assumptions and variances clearly. I also created a simple review checklist, which helped make the improvement repeatable rather than dependent on one person. In your answer, use a clear situation action result structure, quantify the improvement, and emphasize automation, controls, stakeholder adoption, documentation, and sustainability rather than merely describing a spreadsheet change. Question 14. How do you ensure data accuracy in an FP&A model? I build accuracy into the process rather than checking everything only at the end. I confirm source ownership, reconcile beginning balances and totals, use consistent account mappings, and include control checks for missing data, broken formulas, and unexpected movements. I separately review assumptions, test the model with historical results, and investigate outliers. Before distribution, I compare outputs with accounting records and have another reviewer challenge key calculations, definitions, and conclusions. While answering, cover source data validation, reconciliations, control totals, formula checks, version control, assumption review, reasonableness testing, documentation, and independent review before distributing results. Question 15. What Excel skills would you use most often in this role? I would use Excel OOKUP or index match, SUMIFs, pivot tables, logical functions, and date formulas for recurring analysis. I am also comfortable building driver-based models, scenario switches, variance bridges, and management charts. For larger datasets, Power Query can improve repeatability, while VBA is useful only when it adds controlled efficiency. I separate inputs, calculations, and outputs, document key assumptions, and include checks so the model remains understandable and auditable for other users. Be sure to mention functions, pivot tables, data cleaning, scenario analysis, charts, model structure, error checks, and possibly Power Query or VBA, while emphasizing judgment over technical features. Question 16. How would you explain a complex financial variance to a non-finance executive? I would lead with the headline, what changed, by how much, and whether it affects the full-year outlook. Then I would explain the 2 or 3 largest drivers in plain language, supported by a simple bridge rather than accounting terminology. For example, I might separate lower demand, higher fuel cost, and favorable timing. I would clarify what is temporary, what management can influence, and what action or forecast adjustment I recommend. In your answer, focus on leading with the conclusion, using plain language, quantifying the drivers, separating controllable factors, explaining the outlook, and ending with a decision or recommended action. Question 17. How would you handle conflicting assumptions from operations and finance? I would first understand why the assumptions differ and identify the specific driver, such as outage timing, customer demand, labor availability, or project completion. I would compare each view with historical data, operational evidence, and external information, then quantify the financial impact. If uncertainty remains, I would present a base case and sensitivities rather than force false precision. For a material issue, I would document the rationale and escalate it with a clear recommendation. Make sure to cover listening first, defining the driver, validating evidence, documenting assumptions, using scenarios, escalating material differences, and preserving a constructive partnership with operating stakeholders. Question 18. What is driver-based forecasting, and how would you apply it at CMS Energy? Driver-based forecasting links financial outcomes to measurable operating activity instead of relying on arbitrary percentage changes. At CMS Energy, examples could include customers multiplied by usage per customer for sales, employees multiplied by compensation for labor, and project schedules multiplied by planned spend for capital. This approach makes assumptions visible, improves discussions with business owners, and allows faster scenario analysis. It also helps distinguish genuine performance changes from changes caused by volume, price, or timing. While answering, explain linking financial results to operational drivers, give utility examples, distinguish drivers from assumptions, and show how the method improves transparency, speed, and scenario analysis. Question 19. How would you perform a sensitivity or scenario analysis for a major investment? I would identify the assumptions with the greatest uncertainty and financial impact, such as construction cost, completion date, energy demand, financing rates, or regulatory recovery. I would establish a documented base case, then model upside and downside scenarios with transparent changes. I would use one-way sensitivities to isolate individual drivers and combined cases to test realistic stress. Finally, I would summarize effects on NPV, earnings, cash flow, and required management actions. Be sure to mention selecting key uncertainties, defining base, upside, downside cases, changing one variable at a time when appropriate, assessing combined risks, and translating outputs into decisions. Question 20. What would you do if actual results were significantly below forecast near quarter end? I would quickly determine whether the shortfall reflects an error, timing issue, operational deterioration, or a new trend. I would reconcile actuals to the ledger, review cutoff and accruals with accounting, and speak with the relevant operating teams. After quantifying the remaining period impact, I would update the forecast and communicate the facts promptly, including uncertainty and corrective actions. I would never manipulate assumptions to protect a target. Credibility and accurate decision support come first. In your answer, emphasize rapid validation, materiality, accounting cutoff, root cause analysis, updated estimate, leadership communication, forecast integrity, and avoiding unsupported efforts to manage reported results. Question 21. How do depreciation and rate-based growth affect utility earnings forecasts? Capital additions generally increase rate base once placed in service and may support future revenue recovery and an allowed return, but they also create depreciation expense. Forecasting therefore requires accurate project timing, useful lives, depreciation methods, and regulatory assumptions. A project can require substantial cash before it contributes to earnings, creating timing differences. I would model capital spending, in-service dates, depreciation, financing, and expected recovery together so the earnings and cash flow outlook remain consistent. Make sure to cover capital additions, placed in service timing, depreciation expense, rate base, allowed return, revenue recovery, earnings timing, and the difference between accounting earnings and cash investment. Question 22. How would you assess a cost reduction opportunity without compromising reliability? I would begin by understanding the operational purpose of the cost and whether it supports safety, reliability, compliance, or customer service. I would distinguish sustainable savings from timing deferrals and quantify implementation costs, service impacts, and potential future failures. I would involve operations before recommending action and define monitoring metrics such as outage performance, maintenance backlog, and safety incidents. The best proposal reduces total cost while protecting reliability, rather than simply shifting expense into a later period. While answering, discuss separating discretionary from essential spending, evaluating service and safety impacts, quantifying sustainable savings, consulting operations, monitoring KPIs, and considering total cost rather than immediate budget benefit. Question 23. Describe a time you had to meet a tight deadline with incomplete information. For a time-sensitive forecast, I first identified the few inputs driving most of the result and contacted owners for confirmation. Where data was unavailable, I used the latest actuals and documented conservative assumptions rather than creating unsupported precision. I produced a base case and highlighted the items requiring follow-up while completing key reconciliations before release. After the deadline, I refreshed the analysis with final information and clearly explained what changed and why. In your answer, demonstrate prioritization, transparent assumptions, validation of material items, scenario use, communication of limitations, and delivery of a useful answer without sacrificing control quality. Question 24. How would you support quarterly earnings or management reporting? I would support the process by validating actual results, updating the forecast, preparing variance bridges, and ensuring management materials reconcile to the general ledger and approved reporting definitions. I would coordinate with accounting and business owners to confirm unusual items, timing, and outlook changes. Because earnings information is sensitive, I would follow review protocols and maintain confidentiality. My materials would focus on the key drivers, risks, opportunities, and actions rather than overwhelming executives with detail. Be sure to mention actuals close, forecast updates, variance explanations, management materials, consistency with public reporting, review controls, confidentiality, and concise messaging around outlook and risks. Question 25. What questions would you ask the hiring manager about this FP&A role at CMS Energy? I would ask which business areas this role supports and what decisions the team most needs help with today. I would also ask about the forecasting cadence, major capital planning challenges, key stakeholders, systems, and how finance partners with operations and regulatory teams. Finally, I would ask how success is measured during the first 6 months and which skills distinguish top performers. Those questions would help me understand expectations while showing genuine interest in contributing quickly. In your answer, ask thoughtful questions about team priorities, forecasting cadence, business partners, capital planning, regulatory interfaces, success measures, systems, development, and current analytical challenges. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.